Okay, thanks. So I think we'll get started. This is a webinar on the top 10 financial planning tips when considering your move to Australia. So thanks for your interest in the topic. BDH Sterling's got a significant heritage in this area, having moved many people over the course of the last decade. My name's Stephen Ford. I'm the head of UK Financial Planning. I'll be taking you through some of the presentation sections. We have Simon Harvey, who's a dual qualified financial advisor in both the UK and Australia. He's also an owner and director of BDH Sterling. And we have a special guest tonight, Katie Keith, who comes from one of our partners, Equals Money. They're a partner because they help us and our clients transfer a lot of money in various directions around the world, but mostly towards Australia. So we've invited Katie along to give her insights into currency and managing that and making the most of their services. Just a little bit of housekeeping. We know that on some occasions you're probably just listening in and perhaps doing other tasks. You can just keep it on mute. We'd appreciate that so that there's no background noises while people are speaking. We'd like you to keep your questions to the end if you don't mind. So we'll have a Q&A at the end and we'll answer your questions then. That also, Simon's going to lead most of that. That gives him also a chance to read your questions and formulate the answers. So when we get to that section, you're welcome to add more questions in during the session as well. There is a Q&A button somewhere on your screen, depending on where your menu is, and or a chat function. But if you could put your questions in the Q&A section under that button, we'd appreciate that. If you can't work that out, just stick it in the chat. And if you've got any other questions or anything, just stick those in the chat and we'll try to accommodate as we go. That's okay. So we'll get started. I guess one of the moves to Australia, if you're planning to make it, I've gone the other way. I've come from the UK to Australia. So has Katie, and Simon's lived in both countries as well. We know it's a significant move for a lot of people, especially if it's going to be permanent. And so it is a key transition in your life, which involves a lot of finance. So it is an opportunity to take advantage of a number of situations, which we'll walk through through the presentation. And of course, if not done very well, it can end up in some quite costly mistakes, which can be very, very seemingly insignificant and minor, but can be quite devastating if they're not dealt with. So we'll walk through those and just alert you to. There's a lot of this background information just to give you a flavour and sensitize you to the issues that you should be considering in contemplating the move and affecting it successfully.
Thanks, Steve, and good evening, everyone. UK pension planning can provide a significant wealth creation opportunity for anyone moving to Australia. In the UK, we receive tax relief on contributions into pensions. The funds grow tax-free in the accumulation phase, but then we're taxed in retirement when we draw on those pensions. In Australia, the reverse applies. Contributions and investment returns are concessionally taxed pre-retirement, but then all funds are available tax-free from age 60. So for those that have accumulated pension funds in the UK and then can transfer them to Australia, they get the best of both systems. Now, this only works if you transfer your UK pension fund from a UK scheme into the Australian superannuation environment. If you draw on the UK pension directly from the UK scheme, the Australian Tax Office will tax you on that pension income. So if we just move on to the next slide, I'd like to really focus on how you can maximise those opportunities to take tax relief on pension contributions and then subsequently transfer those pension funds to Australia to really leverage those two systems. So in this first example, we have a couple who are both higher rate taxpayers with income of £70,000. If they were to make a pension contribution of £20,000, they'd each receive tax relief of £8,000. So that's a combined total of £16,000. Now, if they did that for 5 consecutive years, they would have pension savings of £200,000 without accounting for any investment growth. Now, if you compare that to having received the after-tax money, it's an £80,000 difference. Now, of course, as I already mentioned, they could then transfer that pension pot to Australia and access the whole amount tax-free. And that represents a return on their investment of 67% without any investment risk. That's purely the return that you get through the tax breaks. Now, the next example, this is even more compelling. This individual still a higher rate taxpayer, but their income is at a level where they lose the entitlement to the personal allowance. Now, if they were to make a pension contribution to a UK scheme of £40,000, that means they would regain their full entitlement to a UK personal allowance, and they get an effective rate of tax on that pension contribution or the tax relief would be £28,500, which is huge on a contribution of £40,000. And you can see the potential return on investment there that just makes that really quite compelling. So if you are a high earner and you might only be in the UK for a year or two before you leave, it's still worth really looking at this. Now, the last case that I just wanted to look at was in respect of a basic rate taxpayer. So with a basic rate taxpayer, the tax relief on the contribution will be limited to 20%. But if you take advantage of a salary sacrifice scheme, you would also get a NI saving, a national insurance saving on your contribution of 12%. And often you'll find that employers will run smart pension schemes where you can exchange some of your salary for an increased employer pension contribution. And that will provide the employer with an NI saving of 13.8%. And a lot of employers are willing to pass that on to their employees. So even in this case, where it's a basic rate taxpayer, the tax relief on a £10,000 contribution, if you also add on the NI savings, can also be significant. Now, if you combine this tax relief with the power of compound interest, I think what I want to highlight here is why you should consider this, even if you are a number of years from retirement, because the longer your money is left in a UK or a tax efficient vehicle like a UK pension or Australian superannuation, the greater the returns you will get from compound interest. So what we did is looked at the contribution you would need to make to achieve a sum of £432,000 if you invested over 10, 20 and 30 years. Now, if you invested 30 years out, you'd have to invest £100,000 to achieve that sum. If you invested 20 years out, you'd need to invest £162,000. But if you invested only 10 years out, you'd need to invest £265,000. So you can see that the longer you have until retirement, the more you can take advantage of compound interest. And if you combine that with the tax relief that's available on UK pension funds, we'd strongly recommend you look at making contributions before you depart the UK. So just some actions from those points. In order to build a strong pension portfolio, maximise contributions before you go. Consider using carry forward pension allowances. This is where you can go back and use up to 3 years of unused contributions from previous years. Ensure your pension fund is invested to work hard for you. So a good rule of thumb is the further you are up from retirement, the more you should have allocated growth assets. And then as you approach retirement, you might increase your allocation to defensive assets, but make sure that your pension fund is just not in a default option and that it is in an option, investment option that is appropriate to your circumstances. Consider salary sacrifice, as I mentioned, for the national insurance savings. And also, if you are a member of a defined benefit pension scheme, now it's generally not considered suitable for UK residents to transfer from a defined benefit pension scheme. But if you are moving to Australia, the different tax regime does often make a transfer very attractive. The fact that you can ask your defined benefit pension scheme for a transfer value where they will offer you a lump sum of money in exchange for the pension entitlement that you have at retirement. And if you transfer that lump sum into the Australian super regime and then can access it tax-free, it does make a lot of transfers quite attractive. So do consider a defined benefit transfer.
The other main area we often get asked about is property, and what should you do if you've got a property here? One of the key questions is, should I sell it before or after leaving the UK? It'd be nice to be able to give you a nice black and white answer, but tends not to be as simple as that sometimes. First of all, I guess it's what tax residency you've got. Yes, you're leaving the UK. You've probably had that UK tax residency moving to an Australian one. So you might be caught in the middle as well. Generally, capital gains tax is due in both countries, but on a property when you're a foreigner, so in other words, you've left the UK, there are significant concessions. So if the property's been a buy-to-let, perhaps, then it may be actually wise to wait till you get back to Australia and become an Australian tax resident. Of course, if it's been your home, then you're subject to or have the primary residence exemption for your property, and so it's making sure that you use that. You can use that even if you leave and go back to Australia, but if you start to rent it out in the meantime, then that can muddy the water. So there's no simple answer. It is something that does need to be evaluated before you leave, particularly if you need to think about, I guess, a house deposit. If you're heading back, then at what point do you need to make sure you sell the house comfortably and have the funds available when you arrive in Australia to repurchase. Some people ask, should I buy in Australia before I move? Generally, if you're a foreign investor, absolutely not usually, because the stamp duty charges are far higher in Australia. A foreigner would mean you're not an Australian national or a citizen. So they would class you as a foreign investor. So it's something to be investigated. It doesn't mean no, but you just should understand that the stamp duty fees are quite significant. So you may as well wait till you get home or are a tax resident of Australia, and that issue goes away. So you'd have to have a very good reason for doing it in advance of heading there. For some Australian expats, it can be worthwhile. It does really depend on the nature of the property. There are a lot of non-cash deductions that you can make, which means you can make a kind of paper loss, if you like, which means when you go back to Australia, you can then put them in your income statement and just lower your tax for that particular year. But it does need quite specific help, and it doesn't relate to all property. That's mostly more recent build properties. Of course, if you go back to Australia, mortgage is 100% deductible as well if it is rental property and things like that. So you need to consider how that weighs into the decisions. If you buy it before you leave, then it's probably going to be a rental, and it may work in your favor because of the mortgage, and you can gear it up quite highly while you're there, and then maybe when you return, pay some of the equity down and balance it out. The other question we often get asked is, should I rent my UK place, or I really want to rent my UK place because I don't really want to give it up, or maybe it's going to be a base and you return periodically. But of course, that all just depends on the income tax. In Australia, you'll be taxed on your worldwide income once you're an Australian tax resident. So you're going to have to acknowledge that. You may also be subject, or it will be taxable in the UK. Whether you actually pay tax or not is another question based on the allowances you have and the profit it's making. But nevertheless, you have to consider that. So you have to expect that to happen. The mortgage interest deductibility is quite different in both countries. So at the moment, it's changed, and it's a lot less attractive in the UK. Only 20% of the interest can be used to reduce your profit, if you like, whereas it's 100% in Australia. So you just got to be very careful, and both those rules will apply because you're going to get a tax valuation in the UK and another one in Australia. And you can claim tax relief between the two, but you've got to be prepared to understand you will probably need significant tax help. Holiday lets in the UK. So let's say, for example, you think, oh, I'm going to go be in Australia for 8 months. I'll keep my house, rent it out for those 8 months, and I'll be in it 4 months type thing. Then you can regard it potentially as a holiday let, but there's a lot of other conditions that aren't similar to buy to let. And you need to understand, I guess, the tax rules about how that may be involved. If you do choose to rent it out, if it's been your home, then you've got to remember that buy to let starts to trigger a capital gains likelihood, which means that you proportionately, in terms of time, may have to pay some capital gains when you eventually sell it. So you just need to understand the primary residence exemption, there's no capital gains to pay. But if you start letting it out, then that will start to introduce that possibility and everything else that comes with it. Capital gains taxation is due in both countries when you sell a property. Different rules though if you're a foreigner. So in the UK, for example, there are concessions, and so after 2015 it's more likely to be taxed, but prior to that not. And there's different methods that will give you different levels of taxation, so it's definitely something that needs to be considered in advance, and you get tax advice to understand that. So definitely, I know it's often feels like a straightforward sort of category of financial planning issues, but it's not really. So it really does pay to get professional advice and understand the consequences of your choices, because a mistake can be expensive, and do that with a lot of preparation so that you have time to plan it. Research the property market, I guess, and make sure if you're going to keep it that it's actually a useful investment. Yes, it might be generating an income, but it may not be that tax efficient. If it's not growing as well as other alternatives, then you maybe are better just selling it and taking your money back and using it in some other fashion. Definitely suggest you get professional tax returns. So if it does get quite complicated, you will need tax returns in both countries, or someone, we have a partner company, sister company, BDH Tax, who could do tax on both end, and then make sure that the credits between the two countries or any rulings that are needed to separate it are done for you. And I guess really, in the end, it's like, do you want the complexity? Renting a property out from a long distance needs someone to look after it and maintain it for you and all that sort of issue. And the prospect of tenants not being there. So, in some cases, it might be easier to liquidate it and invest your money in another way to achieve your objectives.
So general investment taxation. The general rule is that UK non-residents are not subject to UK capital gains tax on the disposal of assets. One exception to that is residential property. The UK may tax you on the sale of a residential property even after you have left the UK. But for those who have accumulated property portfolios, it may still be beneficial to sell the property post-departure, as certain gains can then be sheltered from UK tax. As Steve mentioned, that's one area to definitely take advice on. Now, once you've arrived in Australia, and assuming you are on a permanent residency visa, the ATO will tax you on your worldwide income, and that includes capital gains. Now, Australian capital gains will be taxed, measured based on an increase in value from the date you first arrive in Australia. So if you arrive in Australia with UK assets, you should make sure that you have valuations for each of those assets. And when you eventually come to sell those assets, they'll be accessible for tax. And in Australia, your capital gains are added to your other income and taxed at marginal tax rates. Now, you only pay tax on 50% of the gain if you've held that asset for 12 months or more. Now, if we take UK ISAs, for example, obviously they enjoy generous tax treatment in the UK. Any gains or income within an ISA are tax-free. But the ATO would look straight through that ISA wrapper and tax you on any gain at the time of liquidation. So if you had a collective investment in equity ISA, say, and you arrived in Australia, sold that 2 months later, you'd need to declare any gain within your tax return. And again, any other unwrapped investments such as unit trusts, OICs, etc., shares, you need to consider this before you leave the UK, and potentially it makes sense to, if you're certain that you're going to remain in Australia for the longer term, it may make sense to liquidate those holdings if that can be done without any UK tax, and then invest in structures that might be more tax efficient for your new Australian residency. Just moving on, the actions from this would be get professional tax advice, and I'd say more than a year out if possible. Consider encashing before you leave the UK, just to keep things simple, and consider the timing of your move to minimise tax. You know, it is possible to leave at certain times in the year to optimise your position, and that depends on your specific circumstances, but it can make a difference. So again, another reason to take advice.
One of the other areas of taxation is inheritance tax. I'm an Australian, so we're not used to that concept, but living in Britain and just about ready to be exposed to it, it is a significant taxation issue that we normally don't have to deal with. So if you're returning to Australia, that's a good thing, because it makes estate planning far simpler, because it doesn't exist. And so that carries a lot of weight, and it reduces the exposure. If you do leave assets in the UK, though, they will be subject to IHT. You do have allowances, nil rate band allowances that can protect you from some of that. That could protect you from maybe £650,000 of assets that are subject to IHT. But once it moves beyond that, then it can start to be expensive, because 40% of anything above those limits can be subject to inheritance tax. Pensions are exempt, though. So, you know, I guess one of the issues of putting money in the pension, like Simon talked about, and taking all the tax relief, they will have to remain here till usually your age of 55. But because they sit outside the IHT or inheritance tax regime, there's no exposure to inheritance tax. It's also a good way to mitigate that. If you've made gifts to other people, like large sums of money, then they can also be trapped in the IHT. So even if you've done that prior to leaving Australia and it's substantial and it came from UK assets, it can still be captured in that net. That declines over the period of 7 years to nothing, but it can be caught in that net. So maybe if you're planning that, acknowledge it, or do it well out, or wait till you get to Australia to gift something. One of the nasty problems of IHT is you've actually got to pay the tax bill prior to the completion of probate, which really means that, let's say you've inherited something or passing it on, then the people who are going to receive it need to pay the tax bill somehow, then eventually get access to the assets. So let's say it's a house, and the tax bill is, I don't know, £50,000, then they've got to pay that money somehow. And then eventually the house might be given to them and they can access the rent and other activities. So it's just that kind of timing issue. These things can be managed, but it's something to be appreciated, and it's best that you get out of the system. But if you have left assets here, that's going to be, for your beneficiaries, something that needs to be understood. If you are UK domiciled, and that can be usually quite complicated idea, but it's usually where you're born or where your father's born, or if you're not, if they weren't married, it's where your mother was born. But it's a kind of a status that you hold related to usually where you grew up and were born. That travels with you. So if you were born in Britain and you return and go and live in Australia, then you would still be regarded as UK domiciled, which means you are still subject to inheritance tax on your worldwide assets, even though you're now an Australian resident. I'm not, because I'm Australian, and so if I go home, I don't have that problem. So it is possible that you can change your domicile by choice. So when you get there, if you are of non-Australian descent or domicility, then it's best to try and change if you're subject to IHT in Britain. So make sure if you get there and you are not Australian domiciled, that you make that choice when you get the chance. If you can trim down your assets or dispose of them in the UK, run them down, gift them out, perhaps remove them generally, it removes the liability. Life insurance can be used to pay the IH liability. So we talked about having to pay the tax. You can have a life insurance policy that kind of covers what the tax is likely to be. That pays it all off and can be a relatively inexpensive tool to manage that. One simple thing is that every superannuation and or pension scheme always want to know who your beneficiaries are should you pass away. it's always very important to have those nominations up to date so that the right people will benefit from your activity. Otherwise, you leave it to others to decide. Wills and power of attorney, I guess, you know, a lot of us don't probably take as much notice of this as we should, but they are fundamental to making sure your assets pass to those that you would like them to. Wills in particular, if you have British assets and you die intestate because you haven't got a will, there's a specific set of rules that decide how the assets are passed on, and it's not always completely to a spouse. And it runs down your family lineage. So it's best to get it sorted out and make sure you've got a will in Australia and the UK if you've got assets in both countries. One thing to be conscious of is if you do move to Australia, but let's say your beneficiaries, maybe your children remain in the UK and you want to eventually pass your wealth on to them, that even though there's no inheritance tax in Australia, there can be capital gains tax because they're foreigners when you're passing it on. It can be managed, but it's just something to be aware of and make sure that if you are doing that, that you're protecting the beneficiaries from any exposure. One thing to understand in the UK, particularly with assets, is that spouses and relatives are not automatically given power of attorney. Power of attorney is the right for someone else to decide your finances and or your health when you're not capable of doing it. But it's not always the spouse that gets it. So it is better to have this written down in both countries so that you know who is going to make those decisions for you, and that's clear to everybody. Otherwise, you leave it to someone else to decide, which may not be your preference. So make sure you get your wills and power of attorney in place, especially in both countries. And make sure that you are Australian. If you've got Australian assets, you're going to bequeath to people who live outside the UK, or in the UK rather, that you set up the right types of tools to get that sorted and keep everything up to date. So I know it's a challenge to do that, but you want to make sure that everything's heading in the right direction. Insurances, I mean, I know they're not the most exciting topic, but when something goes really, really wrong, it can really impair your finances, as you're well aware. So it's important to make sure that you have the right protections. But you need to check if you've got them in the UK that they would actually pay out when you go to Australia. A lot of them may not. So you have to check those conditions, either make sure they will and when you sign up, or if they don't, maybe the point where you cancel them. But make sure if you do cancel them, you have something else in place. A lot of superannuation schemes have insurances attached. You pay a little bit extra and they can have other insurances involved. So you need to check that your schemes, if you're heading back there, don't already have that, and whether you're duplicating some of those. You'd have to be aware, I guess, though, if you are taking super, then sometimes if you take it as large lump sums, those insurances are gone. So it's just making sure you understand what you have and as you change, whether they're still relevant. So review all your insurances, make sure they still apply. If you're moving across like life insurance, income protection, that type of activity, make sure that there's the right kind of continuity. Check what your super schemes have got and make sure that as you are moving that you're not left in a middle ground where you haven't got anything set up as you make the transfer. UK state pension, it's payable in Australia. So if you've been here and earned an NI record of at least 10 years or national insurance record, you know, Simon mentioned that in the tax that you're paying national insurance credits usually through your working life in the UK. That equates to about 9,200 as a full state pension at the moment, which is about 16,500 Australian dollars, the current exchange rate, which is a handy amount of money, particularly if you're a couple. It's indexed in the UK, so it goes up with inflation. But if you move to Australia, it's payable, but it just won't be indexed. So it's definitely worth making sure that you are clear on your UK state pension record. The age pension in Australia is payable as well, but often is income and assets tested, so it can be quite difficult to qualify. But if you've earned the British version, then it's best to make sure that you understand you can get it and make sure you know how to have them send it to it when you're of that age. So the key thing is just make sure you check your national insurance record. You need 10 years, you can have a maximum of 35 years, and you can buy up to 6 years. So it's a bit of an equation just to decide whether it's worth topping up your record to get any at all and or more. So you can make sure that you can get something. Even if you're just getting the 10 years, so the low end, it still can be 2 or 3 grand. So it's a decent little chunk of money coming down the track. Simon mentioned a little bit earlier that I guess as you move from one tax system to the next, they've got different tax years. And I guess if you basically say, well, I was only working in one for half the time and the other half the time, I haven't earned as much as I normally would in either. So you pay 10 less tax, sort of is the broad logic. And there's also loads of credits and deductions and things that can shift. So it is really worth trying to make sure you understand. And if you can orchestrate an optimal timing, sometimes if you have large losses that you can put into your tax statement back in Australia, you want a full tax year to make sure that you can make the most of the tax benefits. So it might be worth making sure you get back on July the 1st, if you like. So just all those considerations that matter. One thing that's unique to Britain is what's called spousal transfer, which means that you can transfer an asset to your spouse without triggering a capital gains event. When they sell it, it will be subject to capital gains, but it means you can use the allowances and possibly their lower income to make sure that you shield yourself from some of these choices as you make the move. So maybe just before you move, you transfer the assets, you sell them under your partner's name, and that lowers the overall tax bill. Make mistakes here, though, it can be quite costly. I had a case the other day where the person decided on the day they arrived in the UK, they rented out their former home in Australia. The result of that was that person became a UK tax resident in both countries now and was going to be subject to double taxation. So it got really messy. So it's a simple thing you would think it's not going to be such a headache renting your house out. The timing was about, I think, 15 days out. It just put that person in a really awkward financial situation. So I guess the repeated theme, get that tax advice based on your circumstances and understand the consequences. Consider the timing, pros and cons of each of the assets you've got and how that might relate to the shifts in the taxation and through the year. Utilize that spousal transfer if you feel like you're going to have to sell down stuff to minimize tax. And don't forget also that the British tax system works like you're going to be here for 12 months. And so it takes tax out like you're going to be paid here for 12 months. But if you leave after 6, you really are often due a refund. So don't forget to ask for it when you head back. I'll hand over now to Katie and she'll tell us a little bit more about currency and transferring your money.
Yeah, thanks very much, Steve and Simon. It's an absolute delight to be here tonight to share more about the importance of managing your currency risk, but more importantly, just being prepared with your finances as you plan to move to Australia. And I feel like you guys have given me a lot to think about and some tips for myself, actually. So I've got some notes that I've written down. And I really appreciate the introduction, Steve. Just to confirm, my name is Katie Keith and I work with Equals FX, who are a specialist currency provider based here in the UK. And you may be able to tell from the accent, I was born in Sydney and I moved to the UK in 2016. I am now pleased to call the UK home, don't ask, but I do find myself missing the Sydney sun, although this week I'm worried about the house going underwater. So for the best part of 20 years, I've worked for Australian banks, with a particular focus over the last 5 years with working with professionals and families just like you who are planning to move to Australia and many other countries around the world. So based on my experience working in the industry and having gone through the big move myself, I'm hoping to share my top 3 tips with you this evening around managing your finance to make it as seamless as possible. So moving on, Steve. Just to recap, Steve and Simon have shared a lot of things for you to consider as you plan to make the move. You'll need to consider tax, pensions, insurances, and all sorts. The list goes on, and even selling and buying property at some point. But these things don't happen straight away, and they take a lot of forward planning, as you've just seen. And they do require a lot of professional guidance. And I'm glad to see that you're all here this evening to start that process. And although these things are extremely important, there are also other considerations to think of before you move, just to ensure that your financial transition is as smooth as possible. For example, for people like myself who made the move without any guidance at all or any support, it was a very costly situation. Not having a bank account, not having access to the local currency, not being able to be paid because I didn't have a bank account. So there's so many problems that you can face if you don't have the right support around you. So my top tips for you this evening, just about planning your finances. The first one is going to be open a bank account up before you leave. I would not leave this for more than 3 months before you actually make the move. So for doing some forward planning, and there are some major Australian banks here in the market that can support you with setting up a bank account three months before you move. So imagine that peace of mind of arriving in Australia, picking up a card, having access to some money and heading down to the beach. It's just something to really think about, just that peace of mind. My second tip is about planning your budget. Cost of living is going to be different. Household expenses will change for you, and you may need to set up a kitty of what you need to send over in the initial months. So there's a lot of big planning happening in the background, but there's also the little things to think about. You're going to need to think about your accommodation, short and long term, when you get there. You've got transportation, hiring a car, buying a car, all of those types of purchases. Then putting the kids in school, education also is quite expensive in Australia, depending on the level of education you choose. And then you've got shopping, recreational activities, and other day-to-day expenses. So doing some forward planning around what does your kitty look like? What are you budgeting for? Is also just as critical as planning for your pension and your tax and in your insurances. So moving along, Steve. My third tip is really focused on managing your currency risk using an appropriate specialist, just like ourselves. Many of us using the high street are at the mercy of huge fees and terrible exchange rates. But it's not just about the cost. It is also about peace of mind. Currency markets have been quite volatile, in particular the pound being impacted by Brexit, and also the Aussie dollar being hampered by uncertainty with market conditions. The list goes on. Next slide for me, Steve, please. So the big questions are, what do you need to consider when choosing a currency specialist to support you with the big move? I strongly suggest that you focus on 3 important factors when you're making this decision. So the first one is security. You need to have peace of mind that your money is in good hands and that you're working with a reputable company in the market that can manage your transfers. At Equals, we do over $3.5 billion in funds transfers every year, and we're a public listed company. They're the types of things you need to look out for. The next big thing is around service. You need to have a specialist who knows the currency market and can give you the guidance and support that you need as you're going through this journey. It doesn't happen overnight. Your transition can take many years, from the time you move with your small kitty moving over there to the time that you're moving pensions and selling your assets. So it's really important to have a person, boots on the ground here in the UK, that can manage that with you. The third big thing to look out for is cost. It is important to get the best bang for your buck. This is an expensive move for you, so every dollar counts. And this all comes down to 3 things: how you trade, when you trade, and who you trade with. So they're the 3 things that I always suggest you look for when you're looking to work with a currency specialist just like us. Moving along, Steve. So how can we help you plan ahead? Well, the first step is to start a conversation with us so that we can best understand what strategy we can put in place for you. We offer sophisticated payment solutions, including forward contracts, limit orders, spot trades, and much more. And this can really help you plan your currency movements over a long period of time and give you the best guidance and support that you need. Because I understand, and we understand, that not every journey is the same. And we often have to help with currency movements in the initial stages, all the way through to the further stages down the track, in particular when you're buying and selling property. And it can go both ways. You might move there and then move back. You might have to come back and forth. I've been here for 5 years and I'm still moving money around. So it doesn't happen all at once. And it is very important that you can rely and trust on the people that are helping you with that. So moving along, just to recap, the 3 simple tips that could help you with a seamless financial transition to Australia. Firstly, look at opening up a bank account before you go. As I said, there are banks here in the UK that can help you with that. And I'm more than happy, and Simon and Stephen can also pass on details to those banks. Secondly, start doing some forward planning on budgets and cost of living. What is your initial kitty going to look like? What do you need to think about now? Forward planning is really key when it comes to making a big move like this. And thirdly, implementing a currency strategy that will last the duration of your moving journey. As I said, this journey isn't going to happen overnight. So you need specialists like us in your corner to help you with that. Moving the money is easy. It's a 3-step approach, as you can see here. It's knowing when, which is the difficult part. So moving along, Stephen, I just wanted to say thank you for having me along this evening. I hope that my tips have been useful in helping you to think about what next as you make the plan to move. I'm open up for any questions, and I just want to say thanks to Simon and Stephen and the team at BDH for having us on today.
Yes, I will add that when I moved, I didn't realize that bank-to-bank transfers were the most expensive way to move my money. So I've learned that lesson. I learned a lot of lessons moving. So I'm hoping we can help you avoid a lot of the mistakes we've all made in those journeys. So we moved to Australia and then we think, oh, it hasn't worked out for some reason. You don't like it. Maybe family's drawn you back. There's a reason to have to come back. Maybe work drew you back, but your plans have just changed. So I've gone 180 degrees when you didn't think they would. So really, I guess a lot of it then needs to be unpicked, if you like, and reversed. So it can happen. It just means you need to understand. And if you're a little bit unsure, perhaps not make too many large commitments until you are clear. Normally, a lot of them maybe take 5 years to unwind even. So it can be a challenge. One of those is that if you've moved your money from the UK pension system, which at the moment you can access at 55 into the superannuation system, you can't access that till 60. So if that money's moved and you decide you want to come back at 59, you're going to have to wait that extra year to get access to that money now. And that depends on the release conditions that you need to meet in Australia. So if you're not fully retired, that's going to be 65. So it is a condition that just delays access to your money. Unlike the transfer of a UK pension to a superannuation environment, you can't transfer it back. So you can't take a superannuation and send it across and put it back in a UK or transfer it into a UK pension. It's stuck in the super, unfortunately. So it is a move that's a challenge. It does mean, though, if you can stay long enough to get access to it, you can take it all out in Australia and bring it over as cash and can be reinvested in the system here. And that can be done effectively to pretty much help mitigate the tax. One thing to understand, if you do then reverse the direction and leave your super there, you can access it, but tax starts to become involved. So the HMRC want their share of the superannuation tax when in Australia there wouldn't be any tax due. And that's still true. So there's no tax usually in Australia, but the HMRC starts saying a component of it now is going to be taxable depending on how you build that pension. That's a complicated area. So again, we would suggest if you're in that circumstance, then talk to us about how we can help you make the most of that. We've done some transfers recently where there's virtually no tax on, I think about £600,000 or £700,000. That's a bit of a ticking time bomb because the increasing growth of those funds are going to get increasingly taxed. So the longer it remains in the superannuation environment, the more likely that, or the percentage of tax is going to increase. So if you are going to reverse direction, make sure that your IHT assets are also protected if you're domiciled. Take that super as a tax lump sum if you can do it before you come back to the UK and become a UK tax resident. So you're still a trained. If you can perhaps engineer an optimal tax residency. Some people like the idea, as they say, of endless summers, so I'll split my time. But you just need to know the conditions because it's not the same and it's not one rule. And you can be in both at one time, in which case then you have to resort to tiebreaker conditions in tax treaties and things like that. But it can be done and it can be orchestrated, and we can help give you that guidance. So be aware of the implications, I guess. If you're wholly convicted about going, that's good. All the circumstances can unfold as you would like. If you're not 100% certain, then maybe some decisions you wait until you are comfortable. But nevertheless, if you do change your mind, then there's a lot that we can do to help you unwind a lot of that and make sure that you are in an environment that has flexibility, if that's a possibility. So that ends the formal part of the presentation, folks. So we invite you now to stick your questions in. I see we've already got 4. So in a moment, I'll just let Simon start asking again. If you want to stick them in the chat or the QA function, please go ahead. Don't forget to make sure you ask questions of currency for Katie while we do have her here. She's got a deeper knowledge than Simon and I on the topic. So please take advantage of that. So Simon, over to you.
Thanks, Steve. We've had a question about temporary residency visas and being on a temporary residency visa prior to going on a permanent visa. What impact does that have for tax and capital gains tax? It's a really good question. I mentioned earlier that the ATO will tax you on your worldwide assets if you are a permanent visa holder and resident of Australia. If you're a resident but a temporary visa holder, you're actually given an exemption from Australian tax on any foreign sourced income, with the exception of employment income. So if you have rental income, say, from a UK property, or you have dividends from a UK company, interest or capital gains on the sale of an investment, say, for the whole time that you're on a temporary visa in Australia, the ATO will not tax you on that income. So that gives you that actually gives you quite a generous window to plan and kind of restructure your affairs to make them more appropriate for Australian residency. And it's definitely an area to get advice to see how you can use that window to your maximum advantage. We've got a question about the stamp duty surcharge for foreign investors. Is it 7%? It depends. It depends what state you're buying in. And we've also been asked, would it be cheaper to pay the surcharge, not rent, and get any uplift in value? Again, I guess that really depends on what the property or what you expect the property market to do in Australia. It also depends how long you're going to be in a situation where the surcharge applies. If we look at the Sydney market in recent years, we've had some really strong growth, for example, but then other areas of regional Australia wouldn't have replicated that same growth. So it really depends on your specific circumstances as to whether you should buy straight away or wait until the surcharge doesn't apply. We've had a question from someone who is, I believe, a US citizen married to an Australian. Do we have experience there? Yes, we do. Tax situation is more complicated for a US citizen because you need to consider 3 tax regimes: the UK, Australia, and the US. Now, that's not to say you can't plan, but it is more complicated, but it is an area we can assist. The same person asked whether they should take the tax-free cash or the 25% pension commencement lump sum from their UK pension before they move to Australia. That is, I would caution you to look into the full implications before you do that. If you take your pension commencement lump sum from a UK pension and fully crystallise your UK pension pot, it then prohibits any partial transfers from that UK pension scheme, because you can't make partial transfers from a fully crystallised pension fund. Now, Australia actually has a cap on the amount that you can transfer to Australian Super in any given year. And if your crystallised UK pension pot is bigger than the caps that apply in Australia, you could make the onward transfer to Australia problematic. So that's definitely an area to tread carefully with. Final question: should we combine from that individual? Should we combine any superannuation we have in Australia with the pension that is converted to super? Good question. Yes, in certain circumstances, it will make sense to do that. To transfer a UK pension to Australia, you have to use a very specific type of superannuation scheme. It has to be a scheme that is recognised by the HMRC as a QROP, so qualifying recognised overseas pension scheme. If you're going to incur the cost of establishing a QROP, and there can often be fixed fees associated for running that structure, it then might make sense to roll across any other Australian super benefits so that they're also included within that administration cost of running the QROPs. So yeah, that's definitely something to look into. We've had a question about offshore bonds and And the point about tax-free growth after 10 years, Australia taxes investment bonds, the gains within investment bonds as income when you draw the money from the bond. But if you've held that bond for 10 years or more and it is a qualifying policy in the eyes of the ATO, then the gain is not taxable. So offshore bonds can be extremely attractive for Australian residents. And they are structures that you can set up in the UK and quite common to use in the UK, but they get really generous tax treatment in Australia. It's very different to the way the UK authorities tax the structure, but they work equally well, if not better. One for you here, I think, Katie. Could you give details on the Australia banks that will enable UK residents to open an account before arriving in Australia?
Yeah, there's 4 major Australian banks that I would do my research on. You've got NAB, National Australia Bank, ANZ. You've also got Westpac and Commonwealth Bank of Australia. Now, CommBank is one of the largest banks in Australia. It actually is the largest bank. They have a very easy online Welcome to Australia platform. You can apply online in about 5 minutes. Westpac have a team here in the UK as well, supporting people opening bank accounts. I worked with the Commonwealth Bank for 10 years. You know, they're a really accessible, user-friendly system. Westpac equally is also quite supportive, and you can look both of those guys up online, moving to Australia, and you'll be able to see their links directly online. It's a very, very simple process. The one thing I need to let you know, you can open the account up, but you can't access anything until you get there. Under anti-money laundering and know your customer, what happens is you open up the account, you can move money to the account, but when you arrive in Australia, you go into the local branch, you're identified, and then you have full access and a card waiting for you. So it's a pretty good process. It does allow you to have that flexibility of having the account when you get there. Hopefully that helps.
Thanks, Katie. We've had a question about receiving a pension in the UK and transferring the money to Australia. Where do you pay tax, the UK or Australia? If you're an Australian resident and you are on a permanent visa, the Australian Tax Office has, or the double tax agreement between the UK and Australia gives Australia the taxing rights for that pension income. In practice, the UK pension provider will still deduct UK tax at source until you apply for relief under the double tax agreement. So if you go through that process of applying for relief under the DTA, the UK provider will then pay the pension without tax, and then you include that income in your Australian tax return. But it is the ATO that has the taxing rights on that income, regardless of whether you actually take the funds across to Australia. They still have the taxing rights on that pension. The exception to that is where you are on a temporary visa, and then the UK retains the taxing rights to that income. We've had another question about stamp duty. How much is it? It depends on the property, and it depends on the state in which you are buying that property. So the best thing is to look at the rates that apply in this state that you're planning to migrate to. That information is all available online, but yeah, it does vary from state to state. If you were born in Australia to Australian parents and lived in the UK for a long time and then returned to Australia, after how long will you be free from IHT liability? In order to be completely free of IHT liability, you need to sell your UK assets, because even after you've broken UK domicile, UK assets are still accessible to UK IHT. But assuming you don't have UK assets in excess of the threshold, there's then a 3 or 5 year period to be off the radar for UK IHT. So it depends on the circumstances again, but generally within 5 years you can be clear of UK IHT, with the exception of any UK investments. Oh, sorry, UK assets. Would it be feasible to arrive in Oz, access the bank account, and then transfer funds into that account immediately? I assume we're talking about cash there. So do you want to take that one, Katie?
Sorry, let me just. How can I charges on FX payments from GBP? So in answer to that, there are no fees or charges that we charge. So that's a really good question, actually. So it's really important to note that we don't charge any fees for the services that we provide, and we are considerably less in terms of the exchange rate because we specialise in foreign exchange and we move large sums of money. We can be competitive, and who we're competing against at the moment is the high street bank. So that's the simple answer: no fees or charges.
Thanks, Katie. We've had a question about capital gains on an Australian property which we already own but plan to sell when we relocate. Now, the timing of when you sell the property is key. If you sell that property whilst non-resident of Australia, the capital gains tax charge will be greater because you won't qualify for the primary residence relief. So it may be best to sell that when you are back in Australia. And then how much capital gains will depend on what period that you held the property for, where it did qualify for the main residence relief. Yeah, so there's a tax calculation there to work out the amount of tax that would be payable, and that's something we can certainly help you with through BDH Tax, our sister company.
I think there was a question around the banking again, Simon. I might throw in here now. So would it be feasible to arrive in Australia, access the bank account, and then transfer funds to that account immediately? Look, you know what? You've got the bank account. You can actually send the money. The good thing is your money can be in Australia before you get there. So by using a currency specialist, we can actually make sure your little transfer kitty, and that's why that forward planning is important around what do you need to have waiting for you. We can make sure your funds are waiting for you in your account when you get there, instead of waiting 48 hours for them to arrive. But if you do choose to do that for peace of mind and security, we're happy to do it either way. So you've got the choice there to have the money waiting for you or send it over at the time. The other question I think I saw there, it doesn't cost you anything to set up a bank account before you go. So it's absolutely free.
So Katie, just so I'm clear, you're saying if I was going to transfer money, I have a bank account here, I transfer the money to you, you transfer it to Australia, and then you put it in my Australian bank account. So it's not from my UK bank to my Australian bank.
That's exactly right, Steve. We broker the transaction in between. So you send us the money, we convert it to Australian dollars, and we actually pop it in your Australian bank account for you. But what we're doing is we're doing it at a much lower cost than the high street bank.
Mm-hmm.
We've got a question about money invested in children's names that's been given by their grandparents. Is it true that Australia taxes income at 47% and doesn't give them the tax allowance given to adults? Yeah, that's certainly correct. In order to prevent people from sheltering or sheltering capital from income tax, they tax investments in children's names at quite penal rates. So something to look at, whether you could use a better structure, a more appropriate structure than a bank account, and perhaps use an investment vehicle that might only be taxed later down the track and give the opportunity for a greater return in the meantime. Another question on state pensions. I'm thinking of moving back to Australia in 5 years and would have been in the UK for 24 years. How expensive will it be to top up national insurance for 6 years to qualify for a UK pension? Well, you actually qualify for a part entitlement based on 24 years. But if you wanted to qualify for the full pension, yeah, you can make those voluntary years, as you say, or voluntary contributions, as you say. The cost of those contributions depends on whether you're self-employed or employed. So the best thing to do is contact the Department for Work and Pensions, ask for a state pension forecast, and ask them for details of the cost to make additional voluntary contributions. But what I would say is that making those contributions, it's cheaper if you fall into the self-employed bracket, but regardless, it's actually quite good value. If you looked at the cost of purchasing an annuity that would pay you a guaranteed income for life, if you looked at that cost versus the cost of making those state pension contributions to get the full entitlement, the state pension will look much better value. We've got a question about someone who's planning to let out their primary residence for roughly 4 years before selling while we're in Australia. Would it be financially beneficial to sell our UK house while still a temporary visa holder as opposed to a permanent resident? Yes, from a pure capital gains tax calculation point of view, yes, because you won't pay any Australian CGT at all if you sell it whilst on a temporary visa, and any UK tax would just be payable on the period where it doesn't qualify for main residence relief. So again, there's a calculation where the period of your ownership is looked at, and the period that qualifies for main residence relief will be tax-free, and then there'll be an element that's taxable. But from an Australian perspective, yeah, beneficial to sell without any Australian CGT prior to getting your permanent visa.
I can see another banking question there, Simon. I might jump in. So can you open a bank account whilst being a non-resident, and is there a limit on how much you can transfer? So no limits on transfer amounts. That's not a problem. I think, you know, typically we've sent full house sales and things like that initially as people are making the move over. I would double check as you're opening your account, that'll have the residency options on the list for what visa that you're going over on. So if you're a non-resident, there'll be a visa option for you to select. I would just select that, which is most applicable to you. So that would be my suggestion on that one.
Thanks, Katie. Another question on IHT. If someone moves to Australia and then gifts money to their children also in Australia, will it fall within the UK IHT and the 7-year rule? I think what we're talking about there is, would it be a potentially exempt transfer or a pet? If someone gifts money to another individual, it's a potentially exempt transfer, because in order for it to fall outside of the scope of UK IHT, you have to survive a further 7 years. Or if you manage to sever your UK domicile and acquire an Australian domicile of choice within that 7-year period, I think that would mean the pet is also completely outside of the scope of UK IHT. So yeah, I think if you're planning to gift money, yeah, do so. It's not going to impede you from acquiring a domicile of choice in Australia in any way. We've got a question from someone who has 2 self-invested personal pensions for their kids aged 10 to 12. Great to see people investing in pensions at such an early age. You're going to get some really good compound interest there. What happens to them if we move back in 12 months? Can you have a super fund for kids? You can't actually transfer those pension funds to Australia until the kids get to 55 years old. So that's the earliest age you can transfer a UK pension fund to Australia, is upon reaching age 55. And so what we typically do for people under the age of 55 is we will manage their UK pension inside, continue to hold it in a UK pension, but can manage it in Australian dollars or in sterling, or a combination of the two. So yeah, those pensions would stay in situ until the kids get much older, and then they could transfer them across to Australia. Even after you've left the UK, you can still make contributions to a UK pension for up to 5 years, and you can pay in $3,600 per annum for that 5-year period, and you still get basic rate relief on those contributions. So if you do regularly fund those UK pensions, you can still continue to do so for 5 years after leaving the UK. We've got someone who's just moved back to Australia from the UK, then instructed my UK pension to pay into my UK account. It is small and not worth receiving as a pension. I think it's too late to change the way of doing it. I assume that I will be subject to UK tax rules on taking the lump sum, that even if I put that into my Australian super, that may not be taxed and at the lower rates now. So if you have already taken a scheme pension or you've purchased an annuity with your UK pension, you can't unwind that. So that pension will have to continue to be paid from the UK. To have it paid without any UK tax, you need to make a claim under the double tax treaty for relief from UK tax. That's a form to complete to do that. And then you'd need to declare it in your Australian tax return. So yeah, if the income that you're receiving from the pension is what we call drawdown income, and you haven't purchased an annuity or taken a scheme pension, you can still transfer those type of funds. So it depends. But hopefully that answers your question.
I think we had a question well from not in the Q&A, but in the chat bar from Vivian. I'm not sure if we covered that one.
Okay, if I have 2 UK properties, one buy-to-let, and move to Australia on a PR visa, will I have to pay double income tax on rental income? It's a good question. Property income is slightly unusual in that the UK will still tax you on that type of income even after you've left the UK. So whether you've got any UK tax to pay on the rental income will depend on whether you've got taxable property from that source in excess of the UK nil rate band. So there may be some UK tax to pay. The income will also be accessible to Australian tax, and it's likely to be subject to higher tax in Australia because it will be added to your other taxable income. But you will receive a tax credit for any tax paid in the UK. If you don't pay tax twice as such, you get a credit for the UK tax, but you need to do returns in both countries. A question just about bank accounts. If you're visiting family for 3 or 6 months, can you open a bank account?
Yes. Yeah, you can. Yeah, just you can open it, and it's great. It's actually great. I've worked with quite a few people who have gone over just for their initial visit, because I know a lot of families that go down under just to do a month or 2 recon, and they'll do the bank account, so they've got spending money and they'll spend a bit of time there. And quite often, if you know, they just close it on the way back. It's really easy. We also provide cash delivery services in London once we open up back up as well. If you're going for a quick holiday over there, we can have some pounds delivered to you anywhere in the UK. I mean, some Aussie dollars delivered to you anywhere in the UK once the pandemic lifts.
Hopefully not too much longer. Okay, I think that's all of the questions. I did have one that was submitted prior to the webinar that I will answer actually. We have state pensions and I have a company pension. I'm aware that our state pensions would be frozen, but a friend who lives in New Zealand for some years has told me that my company pension would face a deduction if I moved overseas. Is that correct? No, I don't think that is correct. As you quite rightly point out, state pensions will be frozen, but your company pension, you will continue to get the the pension increases in line with the scheme's rules for UK resident members. So you'll still get those increases. The tax treatment won't change, but you won't have a deduction. So yeah, I hope that answers that question. The other question was just in relation to someone who was looking to move to Australia on a contributory parent visa, and is there a more cost-effective option? The contributory parent visa is one where you will pay a significant sum to have your visa fast-tracked relative to the age parent visa, where there is a much longer queue. I think one strategy some people do is they go over to Australia and then they apply for an age parent visa onshore whilst in Australia and can get a bridging visa, as I understand it, but I am not a visa expert, and that question is best directed to a migration agent, a registered migration agent, I think.
Is that the last of the questions, is it, Simon?
Yeah, there's just one more question about the property that I was just reading.
Right.
If you move to Australia, keeping a UK property, and have just explained that you get a tax credit in Oz for any tax paid in the UK, how does it work if Oz taxes differently? E.g., you can set off more interest in Oz than the UK. Are you able to offset expenses in Oz that you couldn't in the UK? Yes, you can. What you can do and can't do is different rules for interest on loans against the property, for example. So it's a completely different calculation, and the level of tax might be different, and what feeds into it is different. But you get a credit for any UK tax paid. If the tax payable in the UK is more than Australia, I don't think you get that back. But if it's more in Australia, the credit can be used in full against the Australian tax, if that makes sense. So yeah, each system needs to be looked at individually, I suppose. Okay, someone's just prompted me to the fact that I haven't answered their question on the state pension. Didn't Australia have a pension agreement with the UK until 2001? Would years spent in Australia working, e.g. 8 years, count towards the UK state pension? Then the 22 years I now have would add up to 30 years. I don't think that there would be grandfathering, but I am not certain. I don't think there would be grandfathering there. Best thing to do is ask for a state pension forecast from the DWP and ask them that question directly. There's also plenty of groups, British pensioners in Australia and other groups that do lobby for indexation of UK state pensions. I know it is a bone of contention for a lot of British expats that live in Australia, that they don't get that indexation. So I'd also recommend joining one of those groups as well, to keep abreast of developments in that area, because you know, there is an ongoing challenge to try and get that indexation. Okay, should we wrap that up now, Steve?
Yes, it sounds like it. Well, thank you very much, folks, for your attention and all the questions we've got. That's been great. So we're pleased with the interest. And special thanks to Katie Keith for coming along and sharing all the currency knowledge. It's good to have the deep knowledge that she's got, and even the simple knowledge, like you can set up bank accounts. So we appreciate all that, and I'm sure she'll be back for these. We run them quite regularly. It's an attractive topic for a lot of people. So thank you for your patience. We will send out the link to the video and also the pack in the next few days for you as a record, so that you can remind yourself. We've left the information on the screen there, so if you'd like to speak to anyone at BDH Sterling, get in touch. If you want us to help you get in touch with BDH Tax or even Katie herself or anybody else that offers professional services, then just contact us and we'll help you navigate the system and give you our recommendations. So thank you very much, folks, and enjoy the rest of your evening.
Bye, everyone.
Bye-bye.
Thank you. Bye.
Thank you.